Hello, welcome back to Financial Markets Languish with Blake. I am Blake. Thanks for joining me back here. Sorry for the long break. Just been a lot going with my business within real estate, so I've been taking a brief break here, but we'll get back to doing it every day strong from this point forward. Things that we're going over for this market Wednesday, May 3rd. Big news that we missed out since we've talked last. One, the GDP came out much lighter than expected, which most people believe is good news now for the Fed. Gives them more ammo to stop the hiking. The other big thing is we now, have a bank failure that is the new second largest bank failure in American history that got bailed out by the FDIC, sold to JP Morgan. Essentially, they got a steal of a deal of it where they get positive equity in addition to having it and having all the accounts secured by the FDIC. So essentially it's a risk-free, profitful takeover by JP Morgan, which is a no-brainer. Definitely a good situation for them. And this beat out, because we recently were talking about the second largest bank failure just a month or two ago with Silicon Valley Bank. But now Silicon Valley Bank is the third biggest, meaning this bank is now bigger than Silicon Valley Bank in terms of total assets when it collapsed. Meaning that the FDIC is now going to have to, and all accounts it did get bailed out to the full amount by the purchase agreement that essentially was funded by the taxpayers, because now they're just going to raise the rates on lending for the banks, which is definitely a negative for most consumers, which means lower CD rates, lower savings accounts rates, not optimal. And JP Morgan definitely got a steal of a deal on it. Definitely some government mismanagement within that, but I think it's better than a total economic collapse of them doing absolutely nothing. Better to be, greedy and give JP Morgan a good deal than completely screw them over. To do nothing and completely screw over the whole financial system by, not doing anything, letting it collapse, letting the bank runs run up, having everyone, do the old-fashioned Great Depression run on the banks. No one's really looking forward to that, that's for sure. Big news as far as data that we're going to be looking at. The dollar has been falling a fair amount since we've talked last, but in the recent, just couple of days, it's been on the trend up. It's currently sitting at 101.11. And as far as bond yields, similar story with the dollar. It's been collapsing since we've talked last, but recently I've got a bit of a spike. The current 10-year is sitting at 3.442. The current 2-year is sitting at 3.999. Just under 4. As far as volatility has been making a big move down recently, with just a spike literally just coming on Tuesday, with Monday the VIX falling below 15 for the first time in a long time. Other big price actions that we have missed since we've talked last was a recent rally within the entire crypto market, bringing the market cap up to almost 1.3 trillion, which we haven't seen for a long time. But recently it's left off a bit. The current market cap is sitting at 1.14, down a little bit from the recent highs. But so far, year to date, crypto has been quite a well-performing asset, as well as gold. But obviously, by percentage, crypto tends to move more. And this is certainly held true this year as well, being the better performer. But both of them are clearly the two key commodities to be owning, assuming you define crypto as a commodity, which some might not. Some of the data that came out yesterday that we missed is we have the S&P U.S. Manufacturing PMI came out at 50.2, and this was lower than the forecast of 50.4, but higher than the previous month reading in March, which was 49.2, showing a small jump in the S&P 500 Manufacturing PMI, but nothing massive. ISM manufacturing up a little bit more than expected. Came in at 47.1 as opposed to the 46.7 that was expected, and higher than the 46.3 that came last month. As far as construction spending, the last piece of data that came out on Monday, May 1st, that came out at 0.3, which was much higher than the 0.0 that was expected. and definitely a lot higher than the negative 0.3 that we got the previous month. And the first two are for April. This one's for March, but definitely shows that new construction is the winning real estate to own. Due to them, offering incentives to get new homeowners in the door, like additional upgrades for free, or a locked-in lower than market interest rate for a select amount of years, or just having really competitive pricing just due to the housing market running so much recently, commodities running along with them. And now that commodities are down, labor is more accessible. You can finally build houses cheaper in a lot of places than the existing inventory. It's definitely area dependent, local labor markets, local commodity prices, local real estate markets, probably most importantly. Lots of markets in the U.S., new construction is genuinely very appealing. Plus, you have the new additional incentives, which owners in the used market currently are having a tough time accepting the prices because they haven't really came down. So they haven't really had that much of a reason to be looking to unload quickly to whoever gives them somewhat of an offer. Just because the inventory within the entire real estate market's just been so low that, who are they going to compete with? Even though there's still no buyers, there's even less, homes ready to sell. So you're going to buy one of them if you need to buy. And there's the reason why there's still no buyers, and that's going to take a long time to come back. And there's no seller. Like the whole process is slowed down as far as total inventory moving, or the volume of sales, as we like to say in real estate. It's mainly just because mortgage rates are so high, with still 30-year mortgages sitting at 6.5%. This is wildly higher than what people were paying before. So everyone that locked in any kind of mortgage from, the early you'd really have to go back to like the mid 80s, 1980s to really get interest rates in the 30-year that were higher than now. They got close near the 2008 crisis. You could go back. They're very similar. But it appears that, despite what the market's thinking, it's going to be here for a while. So it's just, causing people that got a low interest rate that, they really need to move to want to be able to do it. Because say, for instance, now you're paying a double interest rate on the same value. So you traded in for a similar property, you're now paying upward of 25% more when you factor in the taxes, the new appreciation, the higher rate of interest on the loan. So you're essentially paying significantly more for the same value. And if you upgrade, even more so. And even if you downgrade, you have to downgrade a substantial, more than 25% in price before you even get close to the price of where it was break even with your previous property. So you have to downgrade a fair amount just to pay the same amount. So it's just not a very feasible, environment for a lot of people to want to switch up their arrangement unless they really need to, like a job moving or family relocation reasons or something that really causes them to have to move. But the big moving bubble that occurred in 2020, 2021, 2022, where, there was just so much opportunity, everything went online, there's no need to be tied into the city. Mortgage rates were super low, so might as well just buy a place. It was an entirely different market for sure. And as far as the big data that we're going to be going over that came out today, technically yesterday as of now, just because we're going over this late at night, is the U.S. job openings, which is 9.6 million, which was less than the 9.7 million, which was less than the 10 million that was expected, that was there the previous month. And this is showing a pretty substantial decline in U.S. job openings, which is one of the key things that the Fed's looking at. Having it go down another 0.4 million or 400,000 just within another month definitely shows that the labor market is starting to dry up. These jobs are starting to disappear, and hopefully there's not going to be much more wage price spiral, wage inflation. Which we still be getting high the last few months, but hopefully in the following few months, this will come down in addition to the new, rental, homeowners equivalent rent, which is how they measure 30% of the CPI, which is lagged by 12 months. So this, in addition to that, is going to have a great impact on the CPIs going forward, which is going to look very good for inflation, which, backing up the theory that this upcoming rate hike is going to be the next hike. As far as factory orders, they weren't up as much as expected, but they were still in the positive. They were positive 0.9, not as high as the 1.3 expected, but much higher than the previous month at negative 1.1. As far as things that we're looking out for tomorrow, Wednesday, we have the ADP employment, so the amount of jobs that were given according to ADP in the month of April. It's predicted to be 133,000, which is more than the previous month of 145,000, or less than the previous month. And this is just a prediction, by the way. But the previous month is the actual of what it was the previous month. As far as the S&P U.S. Service PMI, it's expected to be the same as the previous month, which is 53.7. As far as ISM services for April, small growth from the previous month is expected at 51.8 as opposed to the 51.2. And the last and most important thing of the day, we have the Federal Reserve interest rate statement coming out at 2 p.m. Eastern Standard Time, and then we have the 2:30 Fed chair press announcement going over why he made that rate decision and what's next. At this point, based on the current bond yields, you can look at the CME watch tool, which I'll present right now. It looks like it's almost guaranteed it's going to be a 25% hike. I personally weigh this at over a 50% chance. There might be the smallest of chance he goes with a 0 if there's some massive I couldn't see him going higher at this point. I could see him, and I'll get to this in a sec. I'll just get to that in a sec. But I could see him going 0 if there is massive unexplained banking risks that we haven't, yet been mentioned by him or by other banking officials. Obviously, with interest rates going up so much, all these negative losses on bond holdings and on equities is just weighing on these firms. Plus, not to mention all these loans they've already written at these much lower rates. Now with the federal funds rate being higher, they're essentially taking losses on these loans, even if the borrower isn't defaulting, just because they have to pay a higher federal funds rate on their end of the loan. So yeah, just a difficult sector for banking. Going to take some years to adjust, just because everyone was used to the easy money era, which went from 2008 onward. So when you have a fiscal policy for over a decade, banks and everyone kind of start predicting future models to look the same, just because that's all they've been. So definitely caught a lot of people off sides that weren't really watching, or in the case of Silicon Valley Bank, didn't have a risk mitigator even at the firm at the time. So that could obviously cause some problems when new risk is entered into the equation. But yes, so I think there is a small chance that could go 0, but it's 90% plus going to go 25. But I think the bigger thing about this rate hike meeting is what's coming next. It sounded like from the last one, this one's going to be the final one, and based on the Fed target rates, this is going to be the final, the target rate which they put out every other Fed meeting, going over what they predict the future rates to be. This one is supposed to be the final predicted rate hike, and this is what they've been projecting for the last 6 or 7 months, which is pretty unusual. Normally the Fed gets their rate hike sequence not correct. So for them to be as correct as they were this time is definitely out of the ordinary for them. But that's good news for markets were pretty stable throughout the process of having an intense rate hike. Some people argue more, it depends on how you weigh it, but more intense than the Paul Volcker era, but definitely up there, if not the highest, right behind it. And just because of the predictability, I think the Fed's done a pretty good job. But the biggest question is, will it hold? Will it get inflation down quick? How long do they have to hold these rates? And are there going to be more rate hikes to come? The current message from the last meeting is this one's going to be the last one. And they're going to hold these rates high for a long period of time. But I think there's a good chance that one of those two statements could change, and it's definitely dependent on factors in the economy that probably aren't broad public information that a lot of people are looking into at these times. But based on the underlying risk or the fact that inflation is falling much faster than expected, if with the latter, you'll probably get a much more bullish statement from Powell and him saying that, yeah, we might be able to drop rates sooner just because he sees inflation going down sooner. Or if they say they're going to need more rate hikes, that's code for it's going to be sticky. But I mean, from the last few data points, it looks like we're on the right track. It depends on how fast they're really hoping to get it down. And with a lot of people talking about flexible average targeting, not needing it right down to 2 immediately because we ran under 2% for the previous, essentially from 2008 onward. And right after 2008, we actually ran into the negatives, deflation for a brief period. But it's been, under 1% basically that whole time, or around 1%. So much lower than the 2 that they were hoping. So now if we run a little hot, sure, it's more than expected, but it'd average out to 2% over the whole time. But still, I think, overall that's kind of a bullshit. Like, if you're targeting it, you can't just catch up. I think a better statement would be to try to just go back to 2. But obviously, if it's not possible, I think it'd be much better to accept 3% or 3.5% for a little while and not push this into a recession. But if we're going into a recession anyway, might as well get it down. And obviously, if we do go into a recession, I think, the rate of interest is going to be a big factor. But obviously, the recession itself is going to be deflationary to a very similar degree, and almost certainly will push us down below that. So it's definitely a fine line. I think they were slow on the initial hit, but on the way out they're predictable, and they did it at an appropriate pace to catch up. And now the real question with the credibility of the Fed is how are they going to handle it going forward from here. Definitely a lot of questions based on what exactly they see inflationary wise and what exactly they see recessionary wise, and that's what everyone's going to have their eyes on tomorrow. As far as gasoline has luckily been trending down since we've talked last. I know if you're watching this video right now, you're probably going to see high prices at the pump, but don't worry, these high prices are going to be gone here soon. Looks like the gasoline RBOB, or the wholesale price of gas, has fell to 2.44 from the high that reached of almost 2.8. So almost 40 cents there gone. That should translate to the pump, if not even more, because obviously they charge a percentage markup. So if the base amount's lower, the percentage is going to be the same, but the percentage the amount added from that percentage is going to be less. So hopefully you'll be seeing a good 40 cent or more depreciation on your gas price here soon, but obviously it takes a week or two for that to translate. And we have crude oil currently trading at just over 71. Definitely a healthy point for these both to be. Obviously lower would be better, but as far as the turmoil within Russia and the global markets, I think it's going to be hard for us to get consistently below 70 until that sorts itself out. Unless there's some massive surplus of oil and demand just falls off a cliff, which that would be the only reason that there'd be a giant surplus of oil, because the supply is pretty fixed. It's hard to shut it off. It's hard to add new supply. So with oil, it's pretty fixed. It's just essentially demand and being able to get that supply out. But that seems to be pretty locked as far as the current crisis in Russia and the Middle East. It's the ability to get it out, and the rate at which they get it out to certain countries is going to stay consistent. The demand could change, and that would obviously change the price. But hopefully the war, obviously I think everyone's hoping for it to end soon, but looks like that's definitely a couple months out at a minimum. But obviously best, everyone's hoping for the best, and hopefully it can be over tomorrow, but it just doesn't seem likely. Thanks for sticking with me. Thanks. Hopefully you got some good information that you can trade with or use in your daily life tomorrow. And if you need any more information, I'll be back here tomorrow presenting what I see in the markets and what I see in the global world, and we'll cover it. And thanks again for watching. Feel free to watch my previous video here, or feel free to watch a short if you'd like to watch that over here. Thank you.